Good afternoon, everybody. We are in the midst of the FOMC announcement right now. We're getting some wild algo movements out of this candle. So I'm waiting for things to hit. And Fed risks of higher unemployment, higher inflation have risen. Fed says uncertainty about outlook has increased further. All right, rates unchanged, but Fed uncertainty about outlook has increased further. So what does that mean? It's about, it's kind of quasi-dovish. I don't know. Right now, we're getting a little bit of a green candle. Rates unchanged as we expected. Looking at bonds, they're not doing a lot. Doesn't look like there's any other big news. Uncertainty about outlook, yeah. Inflation remains somewhat elevated. So basically, looks like they punted. Let's see what the changes in the statement are. We're getting a little bit of a move higher here. And those rising uncertainty and stagflation risk. Well, there you have it, folks. Initially, all right, here's further. They didn't really change very much. Yeah, there's not a lot there, guys. Off the bat, we got a little bit of a rally. What I'm watching for, obviously, is are we going to get over volume weighted average price? And yeah, so I think we're just waiting on Jay Powell. Slightly positive. Yeah, we got a slightly positive move out of this, but nothing awesome. So this line was where we were trading prior to FOMC 6 months ago, and we keep kind of coming back to it, and we're sitting on it right now. Let's take a look at CME FedWatch. So CME FedWatch, they've got a 28% chance of a rate cut in June and a 55% chance of a rate cut by July. 50% or 60% odds of 2 rate cuts by September. So expectations have dropped a tiny bit for September and a tiny bit for July so far. So again, we're getting kind of nothing out of it. So initially, yeah, we're basically right back to where we were prior to the announcement now at unchanged. Bonds are rallying. The long bond is rallying. And so is the 10-year. Yeah, this is someone, Mike of Albion says, I can't remember the last time we had a move this boring. And, your answer is right. Getting a little bit of selling here. What is the low of the day? We are at the low of the day, which is down 8. But we're below 5,600. That's key. Looking to see if there's any more news coming out. Now we're getting a sell order here. All right. Down 18. All right. So far, a little bit of a sell-off pre-discussion. Remember, we should get a lot of algo gyrations here, both up and down. We've already hit our third standard deviation. We should get a rally here back to 5,600. And then the market will make some decisions there. There you go. All right. So, I continue to believe Jay Powell is going to come on and be a dove. Still pricing in 3 rate cuts this year, just not 4. Futures are sitting at 5,600. We are into a third standard deviation and sitting at 5,600. Again, that's gonna be a spot where I'm thinking about whether I want to go long or not. Well, 55.97, they busted through 5,600 and then bought it right back up. Pretty interesting. We're gonna have a little fight here for a few minutes around 5,600. Usually those levels are those double zero numbers. There's a lot of activity typically around those numbers. And we are seeing that. All right, Hannah wants to know, any targets you think per the movements so far, Mark? Could we be heading back to the middle of these Baldwin bands? Great point. All right, so what you're looking at, this is volume weighted average price, and each of these lines is 1 standard deviation away. So we're currently through our third standard deviation, which means extremely stretched. I think Powell is going to be a dove, and going into the presser, we'll probably get some buying. I'd be looking for us to get back to my Fed line. And then once the presser starts, we're going to be playing in that. Now, the other name I'm watching, and I am long, is IWM. If the Dove case becomes apparent, it's 3 standard deviations, but it's still only 20 points. We've had a very muted day. And IWM, this is the most interest rate sensitive of the ETFs. It's still flat on the day. It's been leading. It led us higher. And now is, continuing to be somewhat resilient here. I am convinced this one is going to be going to back up over 200. IWM is going to go back over 200. And then we are going to see, not today, but I am targeting IWM to be a big leader if the Fed does come out, if Powell does come out dovish. Hannah rightly reminding maybe I should talk about what hawkish and dovish are. So if you're hawkish, that means you are in an interest rate tightening environment. So that means rates are going higher. So the Fed was hawkish all of last year, dealing with inflation. Now, that they're no longer raising rates and people are looking, are they going to be lowering rates? The question is, when do they become dovish? Dovish is when you are in an easing cycle, when you are lowering Fed rates to make it easier to borrow and try to loosen the economy. And the reason why I feel pretty strongly about how they're going to position themselves is the bond market as a whole has been so weak. It's been so weak that, I'm a little nervous looking at, if the Fed really had decided to come out and be hawkish, we could have rolled over to if the Fed had come in and said we're going to continue to tighten or we're nowhere near lowering rates, the 30-year bond, the yield on that would have exploded higher, and that would have rolled over the market, and we'd be talking sub 5,000. Now that we're not at that, when things start to, as we get a little more clarity from Powell, I think you'll start seeing bonds get a little stronger, and that'll strengthen the overall stock market as well. All right. But initially, we are down a little bit. All right, while we're waiting for Powell to talk, let's kind of circle back and take a look at what's happened with earnings. Now, I was with you guys a couple of weeks ago previewing Tesla, and I told you I'm expecting Tesla premiums to drop dramatically, and they have and continue to do so. I've told you repeatedly I'm looking for Tesla options to get to about 58, and then I'm going to be ready to do a trade. And we're extremely close. Remember, we want to see movement stay somewhat elevated, which it's doing. We want to see premiums come off, and we want to see the move kind of within a normal movement. Now, we want to see how it moved relative to the pricing in it. So, for instance, they were pricing at a 10% move. Tesla moved 5. So I really like, I want, we moved less, but we rallied. Premiums are coming off, and movement is staying above the cost of premium. That tells me that we're getting very close to putting on a Tesla trade. I like it post earnings. I believe it's going to go up, and we've been seeing order flow that says that. I kind of warned you guys last week about Apple. I said if there's one stock that kind of scares me, it's Apple. And, you know, it had been overbought into earnings. It is selling off post earnings. It's at its low of the day. And I think there might be more downside. I think the fact that their search dropped today, that they announced the whole drop in search from April, and they're reevaluating their Google relationship. And then they come out and say they have no intention of making general search a general search engine. They're not developing their own AI, and they're not making a general search engine for themselves. Instead, they're concentrating their money on a car that was never built and on a watch nobody wears and on goggles nobody wants. So this company has been financially engineered beautifully, but run poorly. The reaction that kind of surprised me was Amazon. They actually reported great earnings, but their outlook was a little bit soft. So it's kind of done nothing since its earnings were announced. It's been hanging out between 185 and 190 basically since earnings. Now the big happy earnings came last Tuesday. Microsoft and Meta. Meta looks like it's going to go back over 600. It's over its 200-day moving average. Microsoft, I told you at the beginning of the year, I think it's going to end up being the most valuable company in the world at the end of the year. And, you know, they haven't completely built their own AI, but they basically own ChatGPT. And it is integrated into Copilot. So you are, you know, I think Microsoft is much better positioned than Apple. What Apple has is a phone. And other than that, not a lot. So the Microsoft earnings have been great. The premium levels have really fallen off to the point where I'm looking to initiate a trade in Softy in the next day or two. We're not quite there with Meta. Not quite there. NVIDIA hasn't announced earnings yet. We are there with Broadcom, although it's having a nice day today. And now we're starting to enter its earnings cycle. So we are pretty much there with Amazon. So, you know, I have five stocks in my hopper that I am looking to trade post earnings. I've shared some of those with you. You know, Apple, I'm looking. Amazon, I'm looking. I was looking at Google, but oh my gosh. Sometimes it's better to be lucky than good. I've had I've had one lucky and one unlucky. All right. In one of my services, Delta Strike, we had a bunch of bullish action in NVIDIA, and I bought calls. The next day, that night, the Trump administration announced that they were restricting more chip sales. You know, sometimes that just happens. So I just sold my calls and moved on. Google, I almost bought calls yesterday and didn't. And it's a good thing because it is down 8.5%. Ultimately, it's below 150. Ultimately, you get down toward 140, 44. There's a level I'm maybe interested in buying, but there's now a lot of uncertainty around Google and Apple. The Apple drop in search should scare you guys. All right. So we've got all these post-earnings stocks, and I am scanning their option prices and the movement and how much they moved on earnings. I told you we're going to rally back, folks. Ultimate target, we're already back to 55.97. If I was long here, I'd be closing, and then I would look to go back long over 5,600. Nice move higher in IWM. IWM, it gets to 197. I'm going to take some dollars, and then I will, reevaluate going long if it gets back over, if we get back over like 197.25. All right, so, we're watching for lower premiums, movement above the premium level, and I'm watching those earnings. So, folks, we're about 9 minutes away. How much movement can we so if you guys look at all these earnings and looking at everything we're doing, tomorrow I am going to do my first trade with a special situation, this post-earnings thing. Now, the beautiful thing is I'm going to teach you guys how to spot this trend, how to spot this pattern, and I'm going to teach you guys to trade it, and you're going to be able to find this pattern and trade it every single quarter that we have earnings, right? I'm not just giving you these 5 trades, I'm teaching you how I get to them. So if you'd like to join me in this special situation, I would love to have you. I would join Special Situation 365. It's $49 a month, or you can join the annual for $1,300. Now you can see that the monthly is a much better deal. All right, so what I'd like you to do is join me in this special situation and let me teach you how to do this. All right, and then we'll get back to Powell. But I would love to teach you guys how to trade post earnings in a pattern. The time tomorrow is at 12:30 Eastern time. The time tomorrow is at 12:30 Eastern time. And you can join and get these 5 trades for $49 a month. So this is just a little opportunity. I try and meet with you guys. Anytime there's something important, I meet with you guys and give you good trade ideas. This is a great opportunity to, if you've never joined us, to finally make that jump and join me and my team at Option Pit for this special situation. All right, we continue to IWM after making that move continues to hold. Again, I'm targeting kind of a 197 level. Oh yeah, what color is Jay Powell's tie going to be? Are we going to be streaming this in the conference in, Justin, so that we can make fun of it and make fun of their great the awful questions that are asked by the media? Yeah, to watch it. I don't know that Powell wears a MAGA hat. All right, so just watching here, you can see we're just kind of hanging out, down 13. I would imagine we're going to get a move back over 56.15, and then once we're there, we're going to get some decisions. In IWM, yeah, I want to get us back, once we get back over 197.60, with a closing 5-minute candle, I want to be long. That's where I'm going to be living. Oh, I can't wait for the Powell conference. All right. We got 4 minutes. Questions for me. Again, this is going to be 5 stocks, calls and puts, and I'm going to teach you how to spot this pattern post earnings, and you'll be able to do it. What color shoes am I wearing? We're going to put on these 5 trades over the next, we should put the 5 trades on over the next 10 days. So I will be wrapped up with putting the trades on by next Friday. And I would be looking to exit by the end of the month. Getting a little bit of a rally back here. What I told you, 5,600. We get a push back above 5,600 here. You can ride it up to 5,615. I'm going with like a chartreuse for the color. Yeah. We don't hold a lot of trades into these types of events. We like trading after and before. It's much better than trading during. So we're looking for that post-announcement trend. IWM back green. I told you we're up. We're bumping 197. That's your exit on a long IWM. And then you're not looking to get back in until about 197.60. SPX, you want to see a clean break above 6,000, and then we'll make it back to 56.15. I'd imagine we're going to be almost perfectly flat when he takes the podium in approximately 1 minute. Stagflation would be extremely bad. This morning's TNA call, I am still holding it. I've not gotten the initial reaction I was hoping for, but again, I still like TNA higher. Disney last night was a surprise. Oh yeah. Disney earnings, look at that, up $10. Yeah, I don't know how Disney definitely does have, they don't, I mean, how much of their revenue is toys? That's, haha. What are All right. The conference is starting. We should be streaming that in here momentarily. And then so we're going to be watching now. Update on bonds.
Really focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment.
All right, here we go.
It has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net inventory investment and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 55,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures.
All right, Russell,
survey
2000,
respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor.
Above 197.60.
Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
We want to know what they're doing with the bond.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation
doesn't
expectations
look
well
happy,
anchored and
does
to
he?
prevent a one-time increase in the price
But he
level
does
from
not want to
becoming
be
an
here.
ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability,
I need
we
to send
cannot
him to my
achieve the
neck
long
guy to
periods of
deal with
strong
that
labor market
turtleneck,
conditions
to deal with
that
that
benefit
turtleneck.
all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment.
All right, we're heading for my Fed line, guys.
To our 2% goal and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can.
We're now above where we were prior to
price stability goals. Thank you. I look forward to your questions.
All right, he did not say anything dangerous there.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question.
All right, we're
A lot
through
has
the Fed
happened,
line, guys.
Since the last meeting, there's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress.
We're
and
getting near
I just wonder if I could press you
197.60
the
on
last
Russell.
part
You
of
can
your
think
statement.
about,
Are you any closer now to
see if this
deciding
thing
which
holds
side of the mandate
197.63.
is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment?
The 5-minute hold for volume weighted average price.
So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications.
Right there to the VWAP.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
What happened to his ear?
I don't think we know. I think if you look where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid.
Use use 50 of those dollars to join me in my.
So it's an economy that's been
in my special situation.
And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve.
Here's how you can join me.
And become clearer in terms of what should be the monetary policy.
That's pinned at the top if you want to join, or you can call my team 888-872-3301. Not getting. Wow, look at that! Look at that.
Around 2021 and supply shocks. But there are some who argue that the current situation has notable differences. Energy costs are down. Housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling, with wage growth running below 4%.
All right.
What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that
All
part, I
right,
think,
there's your breakout.
is moving along well.
All right.
But there's just so much that we don't know. I
Yep,
think,
IWM.
and we're in a good
I'm
position
looking
to wait and see.
for 198.
We don't have to be in a
198.
hurry. The economy has been resilient and is doing
Yeah,
fairly
190.
well. Our policies
198 on the nose.
costs of waiting to see further are
That's what I'm
fairly
looking for
low,
in
we
IWM.
think. So that's what we're doing, and we'll see.
You can see where volume weighted average price is for the S&P.
administration
We're kind of
is
just
entering into
playing in that zone.
negotiations
You see
with
where the
many
5-minute ended
countries
right
over
on the
tariffs.
Fed
We'll learn
line.
more with each week and month that goes by where tariffs are going to land.
56,
And we'll know what the
15,
effects will be
71.
when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now, it does
All right.
seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are.
Oh, this is a big
comfortable with our
question, guys.
policy
Pay attention.
stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary
All right, well, if
policy
you
is.
ask me, the fact
So
that
we're not in that
everybody's
place,
waiting,
and,
that's what
as
is
that
telling me
develops,
what the economy is doing.
I can't really give you a time frame on that.
John L.
You basically punted on when could they.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So
Yeah, it's definitely AK. We don't know what Trump will do day to day.
We've had
That Bloomberg reporter just asked one of the most worthless questions I've ever heard.
Inflation coming down in the mid to low twos. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know,
Yeah, right now,
then we will see.
still just kind of holding firm
toward our goals.
right at the Fed line.
We might see a delay in that. I think in our
IWM?
thinking, we never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing
Continues
is, we
to
don't know.
try
There's so
and
much
rally.
uncertainty about the scale, scope, timing, and persistence.
Now up over $1,
of the tariffs.
up 0.5%.
So that's that. In terms
So
of
it's up more.
preemption,
It is now up 0.5%. The
I
S&P is
think
only up 0.2.
you can look back at the
Shows you
2019
kind of
cuts
what's happening with
as
interest
preemptive.
rates.
I wouldn't say that what we did last fall was
TLT getting a little
preemptive. If
better.
anything, it was a little late. But
IEF looks better.
2019, we did cut 3 times, but the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got, forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can.
Right now, futures are 56.33.25.
To the data will be until we see more data.
Colby.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned it at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus
as I thought?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very
nothing yet.
So again, difficult.
All right. Well,
to make.
We're continuing to just kind of watch, see what happens. And again, they don't
keep it in our thinking now.
So far, he has not said anything, and I was expecting him to be a little bit more dovish.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are. We're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know
who's getting sold. They're still selling Apple.
So following that, just so then, how does
President Trump broadly
as well as the Federal Reserve
just,
to make rate cuts affect your decision today and affect your job difficulty?
The Qs are not having a great
job at all. So we're always going to do the same thing, which is we're going to use our tools
Tesla's
to
roll
foster
over.
maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
All right. Anybody heard anything interesting yet?
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much the degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place. And the right thing to do is await further clarity. And
Right back to
usually things
5,600.
clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very
flying all over the place.
Are concerned and postponing economic
various
kinds. And yes, if that continues,
once he's done talking,
happens to sort of alleviate those concerns, then you would expect.
I think we're going to wrap.
Show up.
I could be wrong.
It wouldn't maybe show up overnight, but it would show
when
up
he's done talking.
And that may be what happens.
I'll give you guys an idea.
Yet. And also, there are things that can happen that will.
If it gets to be
change that narrative. I mean, they haven't happened, but
3 o'clock, like 3:40.
In the meantime, yes, we're watching an
Like we're like 20 minutes to the bell,
but don't.
And we're nicely green, and by that I mean up.
Economic
S&Ps are up.
And by the way, consumers keep spending credit.
More than.
It's still
25 basis points,
albeit one that is shrouded in some very down.
And the Russell is up,
people
50, 60 basis points. I want to own calls that expire on Friday. I'd be looking to own.
Michael McKee from Bloomberg Radio and Television.
199 or 200 calls
by a
Friday.
former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact
he does not like that question.
QE and QE and QE and went beyond the narrow confines of your mandate.
So, well,
that's what I'm looking at.
That's not really.
He was not happy with that question.
I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did.
Someone should ask me if this is transitory. That's
QE,
fine.
and we, of course, tapered and everything. And then we immediately went into QT. And, we're down a couple of trillion, but I get
we're all fans of the Fed here,
could
aren't
have
we?
tapered earlier or faster. That's absolutely right. But this is all very welcome. It's
He's not said anything in greater markets.
We weren't going to get it perfect, and those kind of.
I'm monitoring that. I'm monitoring that IWM chart. Yeah, me too.
Are essential, and we're doing the same thing.
We kind of made the journey I was expecting.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
Back to 5,600.
On climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not on your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we will.
All right, we're getting a little bit more. He's almost done.
But I think some people, wanted to hear it that way. But that's not at all what we meant.
Wow,
that's just not a correct reading of our. But I can see
SPX back to VWAP
using, and we have to take that into consideration.
I'm back to VWAP.
Jolene.
Getting more love. All right, now we're above the previous highs.
Today, I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking
She's giving me Lois Lane vibe
to prompt a rate cut specifically?
Well, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming, or things.
There's a nice move. VIX is starting to really fall off.
They're worried about the a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the sentiment data, but also the real economic data as we assess what it is we should do. And
another special, if you buy the monthly, I may have a vol trade here. I may have a vol trade
economic activity, which translates into higher unemployment.
That will put through
potentially higher inflation.
Special situations that probably trend.
The timing,
is coming off, but
and the persistence of those effects are
at IWM
uncertain.
Told you up to 198.
Clear what the
198 that you can make some decisions. But I like those calls
at this time, and and by the way, our
policies. If you bought those calls,
we think we can.
They were 75 cents.
When it is clear what the right thing to do.
2 seconds ago,
really not at all clear what it is we should do. So people are feeling stressed.
They're $1 now. You're already up 33%.
Job creation is fine. Wages are in good shape.
But I don't have a problem hanging on to
layoffs.
Hanging on to some of those calls for Friday.
Initial claims for unemployment.
I think we're going to continue to go higher.
In any kind of impressive way. So
my target for the end of the day,
in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that,
5639.
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Good dodge there.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that 2 cuts might happen, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
I will say, masterful press conference
projections at every meeting.
So far, saying nothing.
We do it every other meeting.
The only time he actually directly answered the question was the question about.
We don't also.
About the
also, I really
climate change.
a specific projection for where we are.
That was the only one I really think he
6
gave a
weeks, we
very
had the
clear
June meeting,
answer.
and you'll have another.
Do we
estimate.
agree?
I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts.
All right. Oh, guys, it is
could include us
1:59.
holding where we are. We
He's
just are going to need
about
to
done.
see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of
All right.
how
See
the
if he
Fed would
answers one more
handle both
question.
rising
Unfortunately, you
unemployment
probably have
and
to
rising
go.
inflation,
I'd like to
how
invite
are you
you
thinking
one
about the
more
Fed
time.
addressing one?
Join me in a special
could exacerbate
situation.
the other?
I
So a
showed
rate
you, I
cut
walked you through
to
earnings
reduce unemployment
and how I'm
numbers
going
and
to be
inflation
playing
and
them
vice
post
versa. How
earnings.
does that
This is going to be
how
5
all those
stocks.
Well, you
challenges?
just
Just
captured
simple
this
calls
is the
and
issue
puts,
with
and I'm going to
the
teach
two goals
you
being
how to
inflation.
do
It's a
a
very
post earnings
challenging
trade,
question.
and we're going to do it
There
on
can be a
5
case
stocks.
in which one goal
You
is
can join
very
for just
far.
$49.
One variable is
And
very
if I
far
happen to
from
do
its goal, much
another
farther than the
special
other. And if so,
situation
you concentrate on this one.
around
If that was the case.
volatility, you'll end up
It
getting
wasn't a
that
case where they were
in
really
your month
intentional,
as
but if you go
well.
back to 2022,
It does,
was very clear. We
the
needed to
charge
focus
does
on inflation.
reoccur, but
The labor
again,
market was also
49 bucks.
so it wasn't
That's
it
like
wasn't a trade-off.
that's like half a tank of gas
I think you know what
for
our
my
framework document
my
says.
truck.
It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
Oh,
We don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path. And it's on Congress to figure out how to get us back on a sustainable path. And it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think
Who is
they
she with?
don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
another no answer.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very
So that's
different
the
situation.
comment we
I
didn't
just
want
want
to
to
hear.
follow up by asking how much of a rise in the jobless rate you could tolerate.
I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment.
We don't have anything here.
Rate. So I'm not going to try to be very specific about what we need to see in terms of a number, but if we
was a sidestep of all sidesteps.
Deterioration in the labor market, of course, that's one of our two variables, and we would look to be able to support that.
Loves that.
It wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Wait.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend.
All right, I've given you
the US
so
and
folks,
China. A lot of
today,
economists are attaching an awful lot.
I don't know that we're going to laugh more, but I laid out what to do.
Talks. How much importance
if
are
we
you
do
attaching to them
are up in
judging
35 minutes.
to the US economy going forward?
I've talked to you about
in a similar vein,
how we're approaching earnings.
Yes, some economists say
I have kind of laid out why I like the market higher.
Until
I'm a little surprised he's not more dovish.
Economy at risk of some of the sort
We've explained what dovish and hawkish
era
are.
shortages and higher
And
prices.
if
we don't kind of soothe relations.
I invited you to join me for those 5 earnings plays
on that too.
starting tomorrow.
These are not talks that we're in any way involved in.
So if you haven't clicked the link in
what I will say is this:
above my head,
we had coming out of the March meeting, the public generally had an assessment of where tariffs are going, and then
click the link that way.
It was really substantial.
In green.
Than anticipated.
You can also call my team 888-872-3301 and they will take care of you.
And now we have we're in a new phase where it seems to be we're entering a new phase where
it's waiting for him to stop talking.
Beginning talks.
And then we will go up.
A number of our important trading partners. And that has the potential.
If we're not up,
picture materially,
should we exit the plays? Yeah, I mean, I haven't put
it's going to be very important how that shapes.
I would.
I think
we're going to be up, and 2,
how it works out.
I do like the Russell higher all week.
Not trying
but obviously, if we really roll over,
what will happen?
Then we've got a problem. Then I'm reading
when the facts are changing.
And just on the fall in shipping volumes from China over these
yes, JFT, if we signed up for special situations, will the trades also be emailed to us?
Good shortages and higher prices in the coming weeks.
If you sign up for push, you'll go to your phone as well.
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods
only a 50-50 win rate on special situations
in the first quarter.
Yeah, but the wins have been. I got a big
in the impact of
big one lined up for U.S. Steel, and this one's going to be way better. We've had some really nice ones. The last time I did anything like this, we ran 1-6 out of 10.
The decision we made today. Which decision?
So the future decisions. So the volume of the imported goods has increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we I think we think that there was a big spike in imports.
All right, everybody.
Historically large, really. And
I have to go. I have to exit.
That should
trade it. I've got to jump over to
the difference between
trade to close here shortly.
Minus imports.
We'll leave this running
and imports
for you guys to watch.
Conveyed
and you can chat
contribution to,
and you can continue to talk and chat. Once again,
GDP in the first quarter.
Click the link above or give us a call 888-872-3301. That's 888-872-3301. I hope you guys have a great afternoon. For my closers, I'll see you in about 20 minutes.
You could also.
I'm Mark Sebastian. I am your
of the
only option.
First quarter.
Have a good one.
It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So 3% PDFP in the first quarter, that might actually overstate. So it's not really going to. I don't think it's going to affect our decisions. I will just say though that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economy. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses, and so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand. And that'd be a very inefficient way to try to fix supply chain problems. But, we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night. And this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy, when it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.